This is Michael Ken, and this is our market comment for the week of October the 15th, 2013. Hope that everybody enjoyed a wonderful Thanksgiving weekend with family. In Ontario, we can certainly be grateful for a spell of wonderful weather. When I started this commentary, the goal was to do so weekly, with regular comments about the ever-changing investment environment. Recently, that's not occurred as I felt repetitive, as the major market drivers continue to be interest rates and government policy. I've spoken to a few clients who listen regularly and will endeavor to return to bi-weekly comments, even if they are repetitive. Recently, we had Sandy McIntyre of Century Investments in to speak with clients during a luncheon. His message supported ours. Interest rates were in a bottoming process. As a matter of fact, bonds are massively overbought at the moment, forcing investors to pay significant premiums for safety. Historically high premiums, as a matter of fact. However, the safety is hardly safe when one considers inflation and taxes. Further, investors continue to buy bonds and sell equities in an act that can be viewed as closing the barn door long after the horse has left. To some degree, this risk aversion may be due to demographics, as more than 35% of the Canadian population is now older than 50 years of age, and capital preservation is seemingly more and more important. Sandy's belief is to focus on quality dividend-paying equities which pay better yields than fixed income and can produce dividend increases over time. The message of investing in assets that preserve long-term purchasing power was clearly expressed during the luncheon, and is a message we shall continue to repeat. Currently, we appear to be in a mid-cycle correction in equity markets. And given Washington's behavior, and after an extended U.S. equity market rally, this seems reasonable. But when policymakers consider their options, it is likely they will sacrifice inflation in favor of an extended business cycle to correct the government indebtedness in Europe, Japan, and the United States. This should assist in pushing asset values higher again. Sandy's message was consistent with ours. Great companies and dividends will protect investors as they have in the past. An example of current market behavior was seen as we enjoyed Thanksgiving Monday, but U.S. markets were open yesterday. There was despair in the morning that the government had not reached a solution over the weekend, and markets sold off sharply before rebounding upon news of an evening White House meeting with a new solution on the table. Markets are trading on policymakers' actions, but underneath the uncertainty they are creating, there is an economy in the process of recovery. Employment is improving. Corporate balance sheets are strong and cash-laden. Consumers are becoming more confident, and U.S. household wealth has achieved a new all-time high. There are numerous reasons to be optimistic, if only Washington could remove the uncertainty of their debt ceiling, which needs an inevitable solution. After all, their creditors, namely China and Japan, could demand significantly higher interest rates if the U.S. were ever to default on its debt, and Washington can ill afford to pay more for its debt. We expect logic to prevail, even in Washington. Portfolios continue to focus on dividend payers and high-yield debt. Within our equity allocations, we continue to add U.S. and global equities in favor of Canadian equities at the moment due to a number of valuation metrics. That's it for this week. We thank you for listening and wish you and your family well.